Okay, let's just see who we've got. And then we'll... It's week 10 already. It's nearly finished. It's nearly Christmas. Anne.
Yeah, sorry.
Esther. Niharika. No Monica. No Rachel Korchika. Manuela. Sharmila. Roshani. Craig. Prem. Dora. Cindy. No James. No Rupa. Harleen. Moyan. Murray's not here. Iris. Sam. Asha. Shujana. Nevada. Conchira. Who did I miss? You were at the top with Anne. Got you. I've got everyone, haven't I? Okay. All right, so today we are, just so you keep up to date, because this is in the exam, so most of you were, a few of you weren't, but most of you were in the lecture. You know you've got cash flow, and that's worth 50% of your final exam, but you've also got a question on corporate disclosure. All right, so we're just going to do a little review. So a couple of the bigger questions. So what I'll do is I'll go through the 5.16 one first, and then I'll let you do the 5.14 one on your own. So 5.16 requires you to prepare a profit and loss, a balance sheet, and a statement of equity, and you're given a full trial balance of data. So what I want you to do is just correct it. Instead of me reprinting them all again, just change the dates. So on A, B and C there, as at 30th of June 2018, just change that to 2021. So the trial balance for Black Hole is also at 2021. The retained earnings in your trial balance is not at 17, it's at 20. So it was just to save a bit of paper. The reprinting over the page on page 2. 2018 is 2021. Item F, so that was item D on the 30th of June 2018, change that to 2021. Item F, change that to 31st of March 2022. Item H, change that to 2025. And your actual profit and loss will be as at 2021, as will your balance sheet, as will your statement of equity. All right, so your current year is 2021. So that's that one. And then the next one with the additional handout, this is actually 5.14 out of the textbook. Just change that June 2016 to June 2019. Item B, change that 1st of July 2015 to 1st of July 2018. All right, and your answer will be as at 2019. So change your headings from 2016 to 2019. All right, everything else is all right. The figures, I didn't see the point in redoing it all, but just so we get our things right. So let's have a look at the first one, question 5.16. All right, so just remember, when we're looking at corporate disclosure, there were the 3 primary financial statements, the 3 primary general purpose financial reports we looked at, which was your profit and loss, your balance sheet, and your statement of changes in equity. So your profit and loss, also called your statement of financial performance and other comprehensive income, your balance sheet, also called your statement of financial position. All right, and then your equity is your statement of changes in equity. Now, under AASB 101, there's a few things that you must do. There's a lot of things where you can change the disclosure, but things you must do, you must show current year and previous year, right? You also must show the difference. Have you both got one? Have you got one? Yeah. You must show the difference between current and non-current. Okay, so that's the, you must look at your liquidity and your solvency. Here. Right, you must show taxes and interest separately. Right. Where things are material, you must show them on the face. Where they're immaterial, you can condense them maybe with other items or show them in notes. All right, so those are a couple of the primary things. There's a few other, but just so, because it's been a few weeks since we've looked at this stuff, so I'm just jogging your memory so that when we go through this 516, that it starts to make a bit of sense. Remember, with a profit and loss, you can prepare it and show your revenue and expense items by nature or by function. By nature, it means individual items. By function, it means you're grouping it into similar functions like admin expenses or selling and distribution or marketing, something like that. So you're grouping them into functional groups. All right, so when you do that by function, remember, it can be an arbitrary allocation. Unless, for example, if you've got admin staff that are 50% in selling and distribution and then 50% in other administration, you're taking 50% of their salary into one and 50% of their salary into another. All right, that's an arbitrary allocation because you can't guarantee that they actually spend 50% of their time doing that. When it comes to some other overhead type expenditures, when you are when you're looking at rental of premises and stuff like that, how much do you charge to the administration, how much do you charge to the selling, how much to marketing and distribution, etc. So that you have arbitrary allocations. So if you know exactly what you're doing and what the contributions are, you can do it by function, and from a management accounting point of view, that can actually give you quite good information about what areas are doing better than others when it comes to, particularly if you divide things up into your core revenue areas. All right, so which areas are doing well and which areas aren't. So by function, but by nature is easy because you just have, it's just the group. So it's, you divide it into your expenses are your salaries, expenses, insurance. So it doesn't matter, you're not allocating them out. It's just what you've actually allocated to those expenses. Okay, so that's your profit and loss, your balance sheet and your statement of changes in equity. So 516, so this is out of your textbook. So this is already up on Blackboard, all right? So we'll go through it, but remember I've just changed the date. So those of you who walked in late, the handout I've given you, instead of me reprinting out new handouts, when I realised I've just reprinted the old one and I haven't updated it for the new textbook. All right, just have a look at your book and you'll see what the dates are. So 516, your current year is 2021, not 2018 as per the handout. And therefore there's a few other little dates that are different. So with that handout, you're given a whole list of items. The way you would approach a question like this, if you are required to prepare a full set of general purpose financial reports, you'd go down your trial balance and you classify them, right, as to whether they go into your profit and loss or the balance sheet, right? So if they're balance sheet items, you need to classify them even more. You need to decide whether they are current or they are non-current items. Also, you need to look at what items are in your equity as well, because we have to do a statement of equity. So there's an equity section in your balance sheet, and then there's an statement of changes in equity as well. So your best approach, has anybody done this one already for homework and they know what they're doing? Okay, I didn't think you had. That's why I wasn't really concerned whether you'd done it or not. So now, step one, just let's spend a few minutes going through and going down the list. So see if you can spend a few minutes on your own and you put a little note next to it. Does this go to the profit and loss or to the balance sheet? If it's profit and loss, is it a revenue item or is it an expense item? or is it to do with other comprehensive income? All right. So there's a few items in the notes, but we'll get to the notes later. Let's just classify them. So go down the list, and is it an asset, liability, or equity, or is it revenue and expense? So you know that all revenue and expense items go to the P&L, all assets, liabilities, and equity go to your balance sheet. All right, and other equity items need to go to your statement of equity as well. All right, so just go down the list, put an A for asset, an L for liability, E for equity, R for revenue, EX for expense. Now, if it's an asset or a liability, also decide, is it current or non-current? Current means you're going to get the benefit within 12 months. Non-current means that you're going to get the benefit or have to pay the obligation in a period greater than 12 months. Okay, most of you have nearly done, so let's just go through that because we've got quite a bit to do so far. Okay, so we've got share capital, we know that's equity. Your general reserve, that's an equity item. Retained earnings is equity. Your revaluation surplus, equity. Mortgage loan, say non-current liability. Bank overdraft, right, that's a current liability. 7% debentures. Look at the dollar amount. We don't know whether it's current or non-current. Debentures are usually more than 1 year, so let's put it to non-current liability. Anything with the word payable in it, we've got interest, accounts and dividend payable. They are all current liabilities. We've got a current tax liability, that's a current liability. Provision for employee benefits. Most employee benefits are non-current, but there could be a current and a non-current portion to that. All right, deferred tax liability could be a non-current or a current or a non-current portion. Allowance for doubtful debts, all right, that's associated with your accounts receivable. Your accounts receivable is a current asset, so we put it with our current assets. Your accumulated depreciation on plant and equipment. Plant and equipment is a non-current asset. Accumulated depreciation is a contra asset account, all right, so it comes off your plant and equipment. So it goes with your non-current. Accumulated impairment of goodwill. Right, goodwill is generally something which is going to last for more than 12 months, right, unless it is impaired. So it depends. So usually that's non-current, so non-current asset. Now we've got cash. should be a current asset, accounts receivable current asset, inventory current asset, prepaid insurance current asset, plant and equipment non-current asset, land and buildings, both are non-current assets. Goodwill is an intangible asset. All right, you've got deferred taxed assets. Right, there could be a current and a non-current portion to that. Sales revenue, so we know that's revenue. It's got revenue in the title, so we know that that's going to have P&L. All right, so everything we've looked at previously, it's all pretty much going in your balance sheet. Now we're looking at P&L items. So revenue, you've got sales revenue. Cost of sales, all right, and expense, admin expenses. Remember, we are doing it by function, okay? We're classifying expenses by function. Right, it's an expense. Anything with the word expense in there is an expense and goes in the P&L. So we've got other expenses. Interest revenue, dividend revenue as well, both revenue items. Income tax expense is a current expense item in your P&L. Your dividends paid, dividends declared, all right, they need to be going into your statement of changes in equity as well. All right, so your dividends declared are, your dividends paid will most likely be your interim dividend, and your dividends declared will be your final dividend. Your transfer to your general reserve, that we need for our statement of changes in equity. All right, so those last three, we've got equity items. All right, so we've classified them, so we've done the hard bit. Hopefully most of you, when I was going through that, you ticked it off. Any that you want me to clarify, or you're okay up to there? Because now we've got to look at the admin data. Item A, it says admin expenses include interest expense of $28,700. Remember, one of the requirements of AASB 101 is that we must show interest and taxes separately. So we're going to have to take that $28,700 off our current admin expenses of $265 that we've got in there. We're going to have to minus it out of that and show it separately when we prepare our profit and loss. Item B, all assets are carried at cost except for land and buildings, which are carried at valuation. So whenever you see the word valuation, that means that it's highly likely that we're going to have items of other comprehensive income where there have been adjustments to a revaluation reserve, right? We have a revaluation surplus sitting there already of $85,000. All right, so on the 30th of June, we've got on 2021. All right, so make sure you change that. So those of you who were here early, I told you to change that one from 2018 to 2021. So that's item D. The directors revalued the land and buildings. The revaluation was based on an independent valuation and on fair values. So the land before the revaluation was valued at $195, right? So let's go and have a look at what it is now. So the land, as at 2021, if we go down, it's in there at $220,000 now. It means that it's been revalued upwards by how much? So 195 off the 220. 25. All right. So there's a 25 variation that needs to go into other comprehensive income. And then the buildings were 350 and now they're 380. So there's a 30,000 variation there. Not only that, we need to show the tax on the other comprehensive income separately. So tax is currently at 30%, so we're going to have to show a tax component there. All right, so we'll get to that shortly. There is a mortgage loan which is payable in annual instalments of $50,000 due on the 1st of March each year. So what that means is we're going to have to take out some money out of our mortgage, and the mortgage amount currently is sitting in there at $250,000, of which 50,000 of that is current, isn't it? So we're going to have a current portion and a non-current portion. So 50,000 will be current, 200,000 will be non-current. The 7% debentures are to be redeemed on the 31st of March 2022. So change that to 2022. There is no plan to refinance these. The provision for employee benefits included annual leave of 18,000 and long service leave of 16,200. So that's in our provision for employee benefits. There of, what is it? 32. Okay, the income tax is 30%. So you always do your profit and loss first. All right, go back to page 1. Let's pick out all our P&L items that we identified earlier. All right, so we've got our sales revenue of 825. Tick these off as we're going along. So you might need a ruler or a bit of paper just to make sure you get the right amount. So we've got sales revenue there of 825. Tick. We've got to minus out our cost of sales to give us a gross profit. You don't have to take photos of these. The answers to these are already up on Blackboard. All right. So remember, I put all the answers up for this because we missed out because the zero. We went to the labs and all that kind of stuff, so we did miss out. All right. So we got sales minus cost of sales gives us a gross profit there of 375,000. Now remember, after you do your revenue, you've got to add in your other income. So I've added in other income there of 6,000. That 6,000 is made up of two amounts. It's your interest and your dividend income. All right, so if we go down the list, we've got interest revenue and dividend revenue, 2,500 and 3,500. So tick that off your trial balance. All right, we've grouped it together. Then we've got our admin expenses. So your admin expenses, they're 236,300, right? So in our on our handout there, we got admin expenses there of 265, right? Remember we said we're going to have to take the interest out. So if you turn over the page, remember we had an interest expense there of 28,700. So if we take 265,000 minus your 28,700 gives you the 236,300, because according to AASB 101 we must show interest separately, right? We can't group it together. Right, so we've got admin expenses there. We've got other expenses of 10,000. So tick that off. All right, that's under the admin expenses. And then we put in our finance costs of 28,700 from that note. Okay, from the additional information, item A. So our profit before income tax, 106,000. Our income tax expense of 50,400 has been provided to us. All right, but remember in the real world when you're calculating taxes, there are some things which are tax-free. There are some adjustments that you need to do with deferred tax assets and deferred tax liabilities, right? So it's not always a straight 30% on profit, all right? So you might remember from 5013 when you did your calculations for current tax liability, and then you did deferred tax assets and deferred tax liabilities. Okay, so you may have forgotten, but you did it in 5013. All right, next one, your other comprehensive income. So remember we just worked out our gain on the revaluation of land and buildings. So land had a previous valuation of 195. Currently it's sitting in our books at 220, so there's a variance there of 25,000. The buildings had a current valuation of 350. They're now in our books at 380. There's a 30,000 variation there. So we've got a gain on revaluation there, but there is an income tax effect, all right, on that gain. That's 30% of that 55. So if you use your calculator and just do a quick 30% of that 55,000 of other comprehensive income, the tax effect of that is 16,500. So our other comprehensive income net of tax is 38,500. Therefore, our total comprehensive income is the 55,600 plus the 38,500 to give you the 94,100. Yes? So it's just a case, and if you've ticked everything off as you're going along, right? When you get to the balance sheet, if your balance sheet doesn't balance, then you go back to have a look at what you haven't ticked off to see whether you've maybe put it on the wrong side, have you added it or minused it incorrectly or something like that. Remember the trick with the balance sheet, if your balance sheet doesn't balance, look for the difference. So if you're out by $1,000, you look for $1,000. Otherwise, double it, look for 2, or halve it, look for 500. Okay, and sometimes you can find it quickly just by doing that, right? But sometimes it might be a couple of things that are out of whack. All right, and that's why if you go through, you classify it, tick everything off as you're going along, then you know that you have already used it. All right, so we've done our profit and loss. Now we need to do our balance sheet. All right, so let's have a look at the first part, our assets. So we need to divide our assets into our current and non-current portion. So our current assets, all right, are the items that we're going to get the benefit from in 12 months' time. So under AASB 101, we need to have our headings. So we need to show our cash and cash equivalents. All right, so we've got 500 sitting in there on our cash and cash equivalents. So tick that off. We have got trade and other receivables. Right, so we've got accounts receivable and doubtful debts. So let's go over the page. Your trade and other receivables is made up of your accounts receivable of 58,000, tick that off, minus out your allowance for doubtful debts of 12,800, tick that off. All right, don't let me go too fast. I need you to make sure that you know exactly what you're doing and that you're ticking it off. All right, as you're going along. So I think I don't want to lose anyone as we're going along. Everyone, are you still with me? You can see it, so you tick it off. The next one, there, your trade and other receivables, your prepaid insurance. Now, it's quite common for people to put your prepaid insurance in there. I actually prefer to have a separate heading and have prepayments because a prepayment is a little bit different to trade and other receivables. So accounts receivable you may not get. A prepayment you've already paid in advance. It is actually separate. All right, but it is not uncommon to group it together, and that gives us the 52,200. The next bit is your inventory. So if we go down to our inventory, you see we've got 87,700 there. So tick that off your list. Add all those current assets up, gives you 140,400. Let's do our non-current asset. So we've got a deferred taxed asset there. The other thing to highlight is they are in order of liquidity. All right, so it starts off with your cash, then your trade and other receivables and inventory. Most liquid first. That is a requirement of AASB 101 that they be in order of liquidity. All right, so not alphabetical order, not just in the order that you like, order of liquidity. All right, that's a presentation requirement. Non-current assets, let's get back to there. Normally deferred taxed assets, if you don't know, put it into non-current. All right, but that amount is actually quite small at 9,800, but because we don't know exactly what it's for. All right, if it's in relation to depreciation, for example, accounting depreciation and tax depreciation are not always the same. Therefore, that can arise, deferred tax assets and deferred tax liabilities can arise because of the timing there. Quite often that is over 5 years, 10 years, something like that. All right, that's why conservatively we will always put a deferred tax asset as non-current unless we know it's something that's current. All right, and unless we know the breakup between what portion is current and what portion is non-current. So if we are going to get the benefit of part of that within 12 months, we should actually take it out of that 9,800 and put it into the current. Okay, we've got property, plant and equipment there. So our property, plant and equipment is made up of land and buildings and plant and equipment. All right, so we've also got accumulated depreciation there. So land and buildings have just been revalued, so there's no... Land doesn't normally have any depreciation associated with it, but buildings can, but they've just been revalued. So we've got the straight 220 and the 380 there. Plant and equipment, 225,000. So if we have a look at our plant and equipment, $222,500. Our accumulated depreciation, plant and equipment, $42,500. So tick them off. All right, add them all up together. Property, plant and equipment adds up to $780,000 that we've got there. Goodwill, we've got in there at $95,000. But if we have a look at goodwill, so goodwill is an intangible asset. So it's currently in our trial balance there at $105,000, but we have an impairment there of $10,000. All right, so $105,000 minus out the impairment to give us $95,000 as a current valuation. All right, total up your non-current assets, add your current and your non-current together, gives you $1,025,200. All right, so we've ticked off quite a few items off our list. All right, let's have a look at our liabilities now. So we've need to make sure we divide them into current and non-current. So again, we want them to be order of liquidity. All right, particularly your current assets and current liabilities should be in order of liquidity. We've got trade and other payables there. So if we have a look at anything with payable in it, we've got $82,300. That's made up of your interest payable, your accounts payable, and your dividend payable. Where are they? They're in the middle there. All right. So we've got $2,800, $69,500, and the $10,000. Tick off those three items from your trial balance. That gives us our $82,300. Short-term borrowings, $149,200, is made up of your bank overdraft. All right, of $69,200, and we've got debentures there of $80,000. Okay, so the debentures, let's have a look as to whether we include them as current or non-current. The 7% debentures are to be redeemed on the 31st of March 2022. So it is now the 30th of June 2021. So the 31st of March 2022 is within that 12-month period. All right, so that's why we've got it in at as a current, all right, rather than non-current, because a rule of thumb, most debentures will last for a number of years unless the question tells you otherwise. So we know they're going to be redeemed within 12 months. All right, so they're going to have to pay for them. So we've got the $149,200. Now, the current portion of your long-term borrowings. So if we have a look at our long-term borrowings, remember before we had long-term borrowings there, $250,000, right? Of which item number E said $50,000 was due in March. All right, so you'll notice we've got $50,000 in our long-term borrowings under current, and we've got $200,000 in our long-term borrowings under non-current. Current tax payable, obviously the word current tax usually means you're going to have to pay it within 12 months. So there's $52,100 there, so that's a straight tick off. Short-term provisions of $18,000. Let's have a look. Where are those provisions? All right, so with the note, we have got annual leave and long service leave. All right, so with our note, with our short-term provision of $18,000, item G divides it up into annual leave and long service leave. Annual leave is something which is current and you might have to pay. All right, so as an employee in Australia, you're entitled to 20 days a year if you're full-time, or pro rata for part-time, 20 days annual leave, and it is current, payable, you know, in that year. You may not take it in that year, but most places actually want you to take it, all right, because if it becomes an ongoing liability, if people don't take their leave, that liability is basically sitting on your books and could actually impact your ratios, all right, for borrowings and things like that. So when you're looking at all your liabilities, your short-term and long-term, it can actually, if too many people accumulate their leave, it can be a problem. Your long service leave, on the other hand, it's not due. There's nobody's eligible until 2025. not current, so that 16,200 goes in your non-current section. Okay, so we've also got the deferred tax liability. We'll make that a non-current liability there of 18,400. All right, add up your current, gives you 351,600. Add up your non-current, 234,600. Add the two together, gives you total assets of 586,200. Our net assets, which is our total assets of 1,025,200, minus your total liabilities there of 586,200, gives you net assets of 439,000. That 439,000 should be your equity. Remember, it's a balance sheet. Your balance sheet must balance. So your total assets minus your total liabilities must equal your equity. So we've looked at assets and liabilities. Now let's have a look at the equity. All right, so our equity section, we've got share capital there of 200,000. We've got reserves, 110, and retained earnings of 129. All right, so when we're looking at our retained earnings, we're going to have to go through and have a look at our statement of changes in equity and our reserves. We got 25. Hang on. Let us go and do our statement of changes in equity, and then we'll come back to that equity section. Right, we need to balance it to the 439,000. So let's have a look at our opening balances. Some of them we know, and other ones we're going to have to work backwards for. So let's do it column by column. All right, let's have a look at the share capital first. So the share capital, our current trial balance, we know that it's 200,000. All right, we've been told in item, so we know this figure. We know the balance as at 2021. We've been told in item C that during the year 50,000 shares were issued at an issue price of $2 each. So 50,000 times by $2 is 100,000. So we've got an issue of 100,000, meaning our opening balance of our share capital, all right, was 100,000. Our general reserve, we know that the ending balance there is 25,000 because the question tells us, we can tick that off. Right, the second item from the top, we've got a general reserve there of 25,000. Our revaluation surplus, we know that our ending balance there is 85,000. We know that we have got an adjustment from our profit and loss for our other comprehensive income, a net amount of 38,500. So that's our revaluation of our land and buildings minus tax. All right, therefore, we know what our 85,000 was. We know what the net of tax amount is for our other comprehensive income. Therefore, our opening balance must have been 46,500. Now, our retained earnings, so 129,000, that's what we calculated in our original profit and loss. Right, so our original profit and loss, we know that our, where are we? Our opening as the balance as at 2020, is 128,400. Add your profit there of 55,600. We've paid the dividend. Whoops, my head won't count. We paid the dividend, and we've declared a dividend, so 1 of 20, 1 of 10. We've transferred 25,000 to the general reserve. Therefore, our ending balance must be 129. All right, because in here in the question it tells us that our retained earnings opening balance was 128. From our P&L, we've got the 55.6. We've paid some dividends and we've transferred items to our general reserve. All right, so that balances out to our 439,000. So if we go back here, We've got share capital of 200, reserves of 110 and retained earnings of 129. So the retained earnings we've calculated. Now the 110 with the reserves, what is that? So we've got 25. Oh, it's our general reserve and our revaluation surplus, those two added together. So we've got our general reserve and our revaluation surplus. So the 25 add the 85 is our reserves. All right, I would separate that out. I'd have a general reserve as a separate line item to a revaluation surplus just to make it clear, because the when you're revaluing assets, any ups and downs must be matched off against one another. All right, so you must, any devaluation or any revaluation must be matched against any previous revaluation, devaluations or revaluations. Right, you have to, you can't just keep doing it, you have to match it against previous ones. All right, so we've pretty much ticked everything off. There's your full balance sheet. It balances to the 439. Our statement of changes in equity. Now there are a variety of ways you can prepare a statement of changes in equity. When you do it in this horizontal tabular format, it's pretty easy and it's easy to see. You can do it in a vertical format. All right. When you're in industry, you need to do two of these, one for the current year and one for the previous year. Because you can't normally fit them on the same thing, right? If you go and have a look at Qantas or Wesfarmers or any company that you want to look at and see how they do it, you'll find that they do it this way, and they'll have one for the current year and a separate one underneath for the previous year. Or occasionally you'll see it in so this is a horizontal format. Occasionally you'll see it in a vertical format. And that way you start with your opening balance, with your share capital, your movements in your share capital, so it's a little bit different. This way is a bit neater. All right. Okay, so let's do the next one. This one I'd like you to have a go on your own. So I want you to remember I've said change that 30th of June 2016, change that to 30th of June 2019. So go down the list, decide what you have to do. So if you have a look at what's required first, it says prepare a statement of financial position and a statement of changes in equity. All right, so what that means is you don't have to do a P&L, that all of these items should all be relating to the balance sheet, all of your statement of equity, so go and classify them as asset, liability or equity. All right, and do your balance sheet. So what I'll do is I'll pop that one up so you can kind of see it, and those you might be able to look at that one. It's a bit closer to you, behind you, if you want to see it, whether that's too small. All right, so I'll leave that one up. So I need you to do the balance sheet and the statement of changes in equity. All right, see if you can do that on your own. And put your hand up if you want some help. So even though you don't have to do the P&L, you still need the profit figure, don't you? Because your profit figure from your P&L goes over to your statement of equity and it goes to your balance sheet. So it tells you the profit figure in item A. So remember the rules with the balance sheet. Order of liquidity. I was hearing weird things, but are you practicing dancing out here? Sorry, I thought I was imagining it. I thought I was hearing clicking in my ears. The girl was outside doing a little tap dance. Okay, so just so you know, you've been going, for a good 20 minutes now. So remember the final exam. Final exam is 2 hours and 10 minutes. 25 marks, so it's worth 50% of your grade. Right, so 25 marks is allocated to your cash flow. That means a minimum of 1 hour minimum. You're probably going to need a little bit longer if you muck it up. If you know what you're doing, you'll get through it and you'll be fine. But if you make a mistake and you have to fix it, so that means you've only got 1 hour for the rest of the other 2 questions. All right, so you've got a question on this, and you probably have to, this is an easier type question, you're probably going to have to try to get something like this done in about 20 minutes. 25 minutes. All right? I'm just letting you know, just so that you know what you need to do and that you need to practice a little bit more. So it doesn't matter that you can't do it now, that's fine, I'm just letting you know. All right? Because as far as the exam goes, a question like this is an easy question. All right, so you want to aim to get it done as quickly as possible. All right. Shall we start having a little look where we're at? Okay. So let's have a look at the question and then we'll have a bit of a read of the additional info. So we know we've got plant and equipment net of depreciation. All right, so that means the asset cost minus depreciation equals that 800,000. We've got land and we've got buildings net of depreciation. We've got long-term investments, so that tells you it's going to be a non-current item. Accounts receivable, so we know that's a current asset. Allowance for impairment of receivables, we need to minus that off there. That's a contra asset account, so that goes with your current assets. Inventory is a current asset. Bank overdraft, right, current liability. Your accounts payable and dividend payable, we've got current liabilities. We've got goodwill, it's an intangible asset. Capital, so that's our equity, general reserve and retained earnings. Equity, income tax payable as a payable, so it's a current. Other debtors, we've got 50,000 in there as well, so they're other current assets. So we've got profit for the year of 581, right? So we know that we have to do that within our statement of changes in equity. Our profit for the year needs to go in there. Our opening balance of our retained earnings on the 1st of July 2018, so make sure you fix that on your handout, was 80,000. So we've got part of our statement of equity there. We have to work through that. We have got a transfer of 30,000 from retained earnings to our general reserve, and we have got a final dividend has been declared and it's not subject to approval, so therefore we need to make sure we account for that. So let's do our balance sheet. So as we go through, we're using the word statement of financial position, right? You can use that or balance sheet, it's fine. All right, you can use both of the terminology. So as at the 30th of June 2019, let's look at it. Can you see that all right? Do I need to zoom it up a bit bigger? Up the back there, can you see it? Yep, okay, so we've got current assets. We've got our trade and other receivables there of 590,000. So let's have a look at what they are. So our trade and other receivables, we've got accounts receivable, minus your allowance for doubtful debts of 60,000, add in your other debtors gives you the 590,000. Okay, we've got inventory. So inventory, it's a straight tick off there of 520,000. Total current assets, 1,110,000. Non-current assets, the first one, we've got property, plant and equipment. So property, plant and equipment, we've got land and buildings there, 1.5, Plant and machinery, 800,000. They were all net. If they weren't net, you'd have to have the asset minus the accumulated depreciation. All right. So we've got 2.3 million there. All right, we've got goodwill, net of impairment of 300,000. We've got investments there of 460,000. So we've got long-term investments, so they are non-current assets. Add up your non-current assets, 3,060,000. Add your total non-current plus your total current, gives you total assets of 4,170,000. All right, pretty straightforward. Next bit, your liability. So remember, we've got to divide it into current and non-current, and it's in order of liquidity. All right, so in our assets, we didn't have any cash, but in our liabilities, all right, we have got trade and other payables, which includes your bank overdraft. All right, so let's go and have a look at that. So trade and other payables, we've got accounts payable there of 400,000 and a dividend payable, 3.2 million shares at 8 cents per share, 256,000. We've got short-term borrowings there of 200,000. Actually, I wouldn't agree with, let's have a look. What have we got? Accounts payable, dividend payable. It's arguable, so it's acceptable, but it's arguable potentially that short-term borrowings of that bank overdraft, it's because of the amount, it's 200,000, that is potentially should be above the trade and other payables. Because normally the way businesses operate a bank overdraft is that they do it for business purposes so they can pay salaries, right? So depending on the timing of their monies coming into their business, banks will generally only give an overdraft if they know that you've got other money sitting there. So this company here does have 460,000 sitting in investments, right? So they will allow you to have an overdraft so that you can keep paying your salaries because of the timing of when your money's coming in and what you're going out, right? Normally that bank overdraft would be, I would say, would be more liquid than your trade payables, because your payables has got 30 days, right? Most trade payables is 30 days, so it's 1 month. But your bank overdraft, arguably, it could be the same 30 days or it could be longer, and this is why they've got it second. So it depends. Whoops, I don't know how I did that. Let me go back. What did I do? Are we back? Okay, yeah, your short-term borrowing. So your trade and other payables. So your trade payables is normally 30 days. Depending on the nature of your bank overdraft as to when that needs to go back into credit, because all bank overdrafts are different. It depends on the agreements that you've come to with your bank. Some banks will charge you depending on what your level of risk, some won't. Right, but they will only ever give you a bank overdraft if they know that you've got ongoing cash monies coming in and that you've got other monies to account for it. So these guys have got 460,000 sitting in other investments. Okay, so, but what I'm trying to say is I wouldn't mark you wrong if you had switched them, because there's not really enough time, there's not enough info there to distinguish. The last current one there is your current tax payable of 249,000. So total them up, you've got 1,105,000. So there's no non-current liabilities there. All right. Your equity, we've got share capital there of 2.4 million. We've got reserves of 290,000, and we've got retained earnings of 375,000. Net assets and our total equity balances at 3,065,000. All right, so remember what I said before, if your balance sheet doesn't balance, look for the difference, double it or halve it to see if you can find that actual amount. Now remember, in the exam, I also do consequential marking. right? So what that means is don't force it to balance if the items don't add up, all right? Because I check, it can't balance if they don't add up. So leave it. If you're out and you've spent enough time on it, you've been watching the clock, you know you've got to get on to the next question, leave it and come back to it at the end. But if you force it to balance and it doesn't balance, you're going to get marks deducted, all right? You won't get marks for things that don't add up. That applies to the cash flow statement as well. Because I do consequential marking, don't force it to balance, because at the bottom it has to balance to the cash at bank in the balance sheet, right? Has to balance. So if you just put that there, if your figures don't add up, you're not going to be getting marks for that. So you need to make sure that you add it up for what you've got, because you're more likely to get more marks, even though you might have some of the figures wrong. You'll just get deductions for other things. Right, so you'll get marks deducted for what you've got wrong, not for making incorrect calculations. So you don't have to force it, but to try to make a balance, obviously it's a balance sheet, you want to make it balanced. So that's why it's a good idea, get into a rhythm, classify them, tick them off as you go. All right, same process will have to go when you do the cash flow. Right, you have to get into a rhythm and make sure that you when you're looking at and you're ticking it off to make sure that you've used the items. So now we need to do our statement of changes in equity. So we've got our 4 columns there. We've got our share capital, our general reserve, our retained earnings, and our total column. Remember, our total must equal our equity section, the 3,065,000. Right, so let's start off with our share capital. There was no new issues of shares, so our opening and closing balance is 2.4. That stays the same. Hey, why does it do that? Okay, our general reserve, so our balance as at the 30th of June was 290,000. But in the question it said during the year, 30,000 was transferred from retained earnings to our general reserve. So we're going to put 30,000 in there, we're going to minus it out of our general reserve. Right, we know that our ending balance is 290, therefore our opening balance must have been 260. Because the question doesn't tell us, but it must have been. Now our retained earnings, our closing balance is 375,000. We are given that. We know we've transferred 30,000 out. We have got 256,000 of a dividend that we're going to have to pay, so it's in there as a minus, and we have to add in our profit for the year. So the profit is provided in item 1, 281,000. So working backwards, our opening retained earnings must have been 80,000. So we start off with our ending balance. We account for the 30,000 transfer, the dividend that it's payable, and our profit that we've been provided in item A. Means our opening balance must have been the 80. Right, total it all up, it gives us our 3,065,000. All right, so not so hard, but and a little note down the bottom for your dividends, 8 cents per share. All right, so your share capitals, we've got 3.2 million shares at 8 cents per share. It's 356 that's been provided. All right, so that one's pretty straightforward. So hopefully that was a little bit of a review for you. There's more practice questions like that. If you haven't done the other bits of your homework, make sure you do your other bits of homework. There's also going to be the study pack. Will have some extra things in it as well for you, because there is definitely a question on corporate disclosure. All right, so it's definitely going to be either a profit and loss, a balance sheet, or a statement of equity, or maybe combination. Right, but remember, with your time, there's going to be 3 questions in the final exam. One of those questions is worth 25 marks, and that's your cash flow. Right, so there's another couple of questions. They are going to be split. So you'll have to go and have a look at the study pack when I put it up. All right, so it gives you some extra questions there to practice. So make sure this is, like I said before, these are the easy questions. If you're not comfortable with these, practice, 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 come and see me. All right, so make sure you check the homework. Now, your assignment, so it's all online already. I will I will fix this handout and put it up and put the right dates and that on there. I just didn't want to waste any more paper. And I will put this one, even though most of it's already up there. I think the 5141 isn't, so I'll put that one up as well. Now your assignment, so it's week 10. All right, so your assignment is due end of week 12. So if you haven't started, you're letting yourself down basically, because you need to start, because you've got lots to do. Those who have started will know exactly what I'm talking about. It takes an effort to pull everything all together and to actually do it. And you can't, if you know what you're doing and you're ruthless, you could probably sit down and get the whole lot done in 2 days. But once you've got if you leave it till 2 days before it's due and you don't know what you're doing, and you'll struggle, right? And you don't want to do that. You want to put your best foot forward, because there is opportunities for bonus marks. All right. You might get up to 5 bonus marks if you put in that extra effort. I've actually already got one student who submitted 2 weeks ago. Who's already done it. And they did it on their own, and they've never used it before. So they've dedicated. All right, so you need to now, because it's week 10, we've only got a few weeks to the end of the semester, you need to be ruthless with your time, not just for this unit, but everything that you're doing. If you're enrolled in 4 units, you're all busy. All right, busy with assignments, busy with everything. You need to be a machine, and you need to make sure that you set out your time. And, you know, this is just the last gasp before the end, and then you can party at the end of it. All right, make it all worthwhile. But you will have to put in, I know if anyone's doing like tax as well, because a lot of students kind of do this unit, and to anyone here doing tax at the same time, nearly everybody, yeah, you know, it's a different kind of unit and takes a different sort of effort. But I mean, what it means is that you've got lots to do. All right, so you need to get your timetable sorted for now up until the end of exam week, so you know exactly what you're doing, when you're doing it, how you're doing it, when you're, if you're working and stuff like that. You just have to be ruthless. All right, just be ruthless with your time and with how much time you spend at leisure. I'm not telling you not to spend time at leisure. Sometimes you need to go and watch a movie or go and see your friends and that, but timetable it in. Have your timetable, and time, if you want to make sure that you relax, you timetable it so that you don't feel like you're that you are a machine, because you're a human, and humans, you still have to live life and smell the roses. All right, but maybe you can do that after. Get your money's worth. All right, make sure you get your money's worth out of what you're paying for this unit and for every other unit. All right, okay, that's it. Any other questions for me on the corporate disclosure? So that's a little review there for you. So next week, it's cash flow, and I promise you it gets hard. So the first couple, not so bad, but if you're struggling to manoeuvre it, you need to buckle down, do your homework, and try to do it before coming to class. All right, if you can. Even if you get it wrong, it doesn't matter. All right, because you know it's in the exam. All right, you know it's there, so you know you have to do it, you have to practice. If you do it before you come to class, that means it's more time that you can spend, if you get it wrong, asking questions and getting it right. So this is your study, all right, so that you don't have to. Maybe that gives you an extra couple of hours to go and watch a movie with a friend. All right, if you get into a rhythm and get into doing what you need to do. All righty, that's all. Thanks for coming. I'll see you next week.